Let's go over some potential government responses to cyclical unemployment. Recall that cyclical unemployment occurs as a result of changes related to the business cycle and is not part of the natural rate of unemployment. Cyclical unemployment occurs during recessions. Government policies that could be used to reduce cyclical unemployment can be divided into two broad categories: fiscal policy and monetary policy. We're only going to cover some very basic ideas behind these policies here. We'll get into more detail on both of them later on. Economists disagree over whether and how the government should intervene in a recession, but we'll cover those arguments later as well. Broadly speaking, in order to reduce cyclical unemployment during a recession, the goal of the government policies we'll discuss here is to stimulate economic activity. When cyclical unemployment exists, the economy as a whole produces less than it could if all of its productive resources, including labor, were being used efficiently. These policies aim to induce firms to produce more. Fiscal policy refers to the use of government spending and taxation policies to achieve a macroeconomic policy objective. One way the government can stimulate economic activity is by lowering taxes. The government can lower taxes on individuals or firms. When individuals are faced with lower taxes, they have more money available to spend, which leads them to spend more on consumption, which increases demand for firms' products and allows firms to hire more workers. Those newly hired workers, now that they have income from jobs, will have more money to spend, which will further increase demand for firms' products, and so on. When tax cuts to individuals are employed as fiscal policy, many economists recommend that tax cuts be directed to people with lower incomes, since lower income people are likelier than wealthy people to immediately increase spending in response. For firms, tax reductions can effectively allow firms to produce at lower costs or to earn more revenue from selling at the same price, which can lead them to produce more and hire more workers. The government can also stimulate economic activity by increasing its spending. For example, in response to the recession resulting from the 2008 financial crisis, part of the 2009 American Recovery and Reinvestment Act devoted billions of dollars to infrastructure and other projects around the country. Things like building and repairing roads, bridges, and parks. Increased government spending can result in more jobs working on government projects and more jobs at firms that sell goods and services that the government uses. And again, the people who get these new jobs will have more money to spend, leading to increased demand for other firms' products, and so on. The government can also increase transfer payments. Many government programs that are considered part of the Social Safety Net Act automatically act to adjust transfer payments in response to the business cycle. For example, more unemployment benefits are paid out during recessions, when people are unemployed, than during expansions. The government also enacts new laws that increase transfer payments to individuals and firms. Increasing transfer payments functions basically the same way as increasing government spending. People now have more money available to spend, which leads them to spend more on consumption, which increases demand for firms' products and allows firms to hire more workers, and so on. Monetary policy refers to the management of the money supply and interest rates by a central bank to achieve a macroeconomic policy objective. If a central bank wanted to act to reduce cyclical unemployment, it could act to decrease interest rates in the economy, which is often accomplished by increasing the supply of money. Lower interest rates means that the cost of borrowing money is lower, and this leads to firms borrowing more money for investment and individuals borrowing more money for consumption. With that, we'll see a similar cycle of increasing demand for firms' products and increasing hiring as we did with fiscal policy. This has been a shallow overview of monetary and fiscal policy. Again, we'll cover these in more detail later.